the market valuation is lofty, but it's also based on high earnings expectations. So I think this year, JP Morgan, and I think it's based on consensus estimates, they expect 13% or even 15% earnings growth. And that's obviously mainly driven, at least mainly driven, but a big part of it is driven by the Mag 7. But it's quite interesting. Even after 2025, they expect in the mid-teens growth. So these expectations are quite high, and now the economy needs to deliver. And when you get into this environment, higher for longer, that could stress the economy, especially
Yeah.
Borrowers. And so that's the risks of these companies underperforming is rising, and at this rate every day. And that's one of the reasons why I want companies that are less prone to these issues, with healthy balance sheet. And for dividend investors, I mean, I invest all of my money in dividend stocks, and I talk about it all day, but it is really hard. I mean, I wouldn't put dividend stocks in one group. I mean, there even a company like Broadcom and Apple, they're dividend stocks, and obviously there are value stocks like Altria, cigarettes, and that haven't done so well for more than 10 years. I think people really need to be picky. That's why I said, for a few family accounts, they invest in S&P 500 ETFs, which is never a bad idea, but we are shifting more money into value-oriented dividend stocks, which have underperformed the markets for the past 2 years. But if you zoom out, they bottomed relatively to the S&P 500 in 2021. And if it weren't for this AI tailwind that happened, I think in 2023, I think they would have kept outperforming.